Well, there was some good news on Wall Street yesterday following a horrendous week. So joining me right now to talk a little bit more about the rebound of the stock market, our good friend, the president of Heritage Capital, LLC, Paul Schatz. Oh, boy, I've been waiting to see what you have had to say. But hey, what was it, 1,300 points it rebounded yesterday? I think that's more than it dropped in any given day last week, right?
So 1,300 points. It's the largest single point rally in history.
Yep.
However, that on a percentage basis, which what matters to individuals,
right,
that ranks as like 164th.
Yeah.
The biggest rallies always come after the biggest declines. Always, always, always. So you put them all together and you can, average it out.
Yeah. Now, to what degree are we attributing this drop in both the major indices in the U.S. and worldwide to coronavirus? Is it all of it? I mean, I'm seeing some people saying, hey, politics is playing some of this too.
I think it's at least 90% corona-related. I know they're talking about the Bernie effect. Typically, in an election year, it doesn't matter until you get to the convention, which the Democrats will have, July 13th in Milwaukee. I don't think the Bernie effect has any more than 10% of what's going on.
And for all of what we're talking about, coronavirus ramping up worldwide, this is something that is going to have a lifespan on its own. We're already seeing signs it's dying out in China a little bit. So, knowing that, are we expecting any drops related to coronavirus to eventually rebound, thus making a good investment opportunity?
So we're not over. I think yesterday's rally was important. Not to get too technical, but typically when markets drop as fast as they did, we had the quickest ever to a 10% correction in 6 days.
Yep.
We went from an all-time high to a 4-month low, 6 days.
Wow.
That's crazy.
Yeah.
So now we're in the period where Friday was some kind of low. From there, we typically should get back half of what we lost.
Okay.
Probably roll over again to the downside late March into early April, and then you'll get a much better rally into the summer. But for the average person, if you are watching the TV and you're living every tick of the market, you have too much risk in your portfolio.
Yeah.
If you're frothing to put money to work and you're really excited and you're looking at things like energy and Disney and Amazon, then maybe you should take on more risk. But this is not. Coronavirus may cause a mild recession here. If it does, it'll be the most mild recession in history, and it'll be caused from lack of supply, not lack of demand. So we're in uncharted territory. And the Fed just cut rates half an hour ago.
Oh, I didn't even know. Breaking news from Paul Schatz. There you go. We've been so focused on what's been happening in Tennessee. Here's the thing, though. If we wiped out a fair amount of gains, almost a couple years worth, at least with the Dow, what do you do then if you're a retiree and you don't necessarily have all the time in the world to try to make that up?
Most important, I've told every prospective client, I tell this over and over and over. This was the 9th 10% plus correction since the bull market began. When you feel so bad, take your own temperature. If you can't stomach it anymore, you've got too much in the stock market. And that's a retiree or anybody else. If you feel this uncomfortable, in the next rally, not in the depths of the decline, in the next rally, reallocate your portfolio so you have less in stocks.
Yeah. And again, so what was it? A half-point drop that just happened 30 minutes ago? An emergency drop?
Right. The Fed cut rates a half point. It's a little curious, a little bit of a head scratcher, because they should have done this Sunday night, coordinating with everybody, Japan and ECB and China, and then before the market recovered. Now the Dow goes up 1,300 points, and the Fed cut rates on a random Tuesday morning. To me, it erodes your credibility.
That is interesting. All right, so back to what people can do. Any way to get a tax benefit out of this carnage?
So for sure, if you have losing mutual funds or you've got losing stocks, I'm going to give you an example. You own Delta or you own American. You can sell one. And go buy United or JetBlue or another airline. So you still have your airlines. If you own Chevron, perhaps you sell that and go buy ExxonMobil, so you can take the tax write-off. And then you have a kind of sort of similar position. If you own mutual funds and you owned the Fidelity Growth Fund, you could sell that fund and buy a similar fund like the Vanguard Growth Fund.
Let's see, there you go. Yeah, and it still keeps the relative allocations in terms of industry.
There's always a silver lining in declines.
Okay, last little bit here. When do we know, or are we going to know, if there's a green light and all clear that everything's okay?
So I think in the United States, I'm not an epidemiologist, I can't even spell the word, but I think the headlines are going to get progressively worse. Companies by the thousands are going to warn. They have no idea what earnings are going to be. Our economic reports are going to get worse in the short term over the next 2 months-ish. Here's what the individual investor should watch this. When bad news is reported by companies or economic numbers, and stocks don't go down.
Okay.
Bulb goes on. When they finally go up in the face of horrible news, God forbid it's in the New York subway and stocks go up that day, there's your bell ringing, all clear. Oh. Markets are getting ready to take off like a rocket.
Okay.
But expect bad news, prepare for the worst, hope for the best. This will pass like every other decline has during the bull market. Bull market's not over.
Okay, there you go. We got in as much as we could with Paul. Thank you so much. Good
Thanks,
to see
buddy.
you again, buddy.
Good seeing you.
All right, coming up next, we're going to talk more about a controversial